Hey there, dividend growth stock investors. It is Colby, the DGI Crab, and today I've got a new one that I'm going to be taking a look at to see if it's going to make the cut to be one of the investments that this channel focuses on and encourages, not advises, but encourages you to take a look at if you are a current income seeker. So we're going to run the numbers here looking at SPYI. This has become a very popular income producing dividend covered call ETF that pays out monthly dividends. I've had several of you ask me to take a closer look at that you like it quite a bit, even over something like JEPI. So what I thought we'd do here is take the two covered call style ETFs that I have put aside for the tier 4 investors here on the channel, which are investors aged 54 and up looking for immediate current income at retirement age, and see how they line up against SPYI. If you're new to the channel, when I refer to a tier like tier 4, I'm talking about the 60 high quality dividend growth stocks that I have separated by age into 4 separate tiers, and tier 4 just happens to be where the older folks are. They look for higher yielding individual stocks and ETFs to either get them to retirement quicker, or maybe they're already in retirement and they're just trying to increase their income with immediate yield. Now, I'm not a professional investment advisor. I've run these numbers here myself. You can do the same. Do your own due diligence before making any investment decisions. But I want to see if this one is actually worth adding in to my group of ETFs for the income seekers. So let's kind of break it down here for anyone that's not familiar. So first, you've got DIVO. It's been around for almost a decade now. It's got about $3.5 billion in assets under management, an expense ratio of 0.56%. DIVO typically is going to have between 40 and 50 holdings in it, and the average dividend yield is about 4.5% on the low end to maybe 5.5% towards the higher end. DIVO is a covered call fund that seeks to get both a good starting yield as well as share price appreciation. So we'll take a look and see if the share price appreciation is enough to keep pace with JEPI and SPYI, because we know, if we know anything about these three ETFs, DIVO's not going to outperform in terms of the amount of yield. But yield isn't everything. Share price appreciation is important, even if you are in your older years and headed towards retirement. You don't necessarily want something that's just going to continue to go down in value year after year after year just because it's producing a higher yield. So next we're going to look at JEPI, very large covered call ETF. Believe it is the biggest covered call ETF out there in terms of assets under management, at more than $35 billion in assets under management. It has a very low expense ratio for this type of ETF at just 0.35%, so definitely like that. JEPI could have anywhere from 130 to 150 holdings in it, and the average yield I've seen is usually between 8 and 10%. I believe right now it might even be a little bit lower than 8%, maybe down into the 7s as of the time of this recording. And then there is SPYI. So SPYI has only been around for 2 years. Its inception date was August 29th of 2022. And since SPYI officially turned 2 years old over the weekend, that was another reason why I thought it was time to take a little closer look at it. We've got a couple years of history now to see how it's performed. And let's just take a look at the numbers here. We've got 1.8 billion in assets under management. So it still is not as large as JEPI or DIVO to this point, but it hasn't been around as long. So there's There's a big reason for that. It does have the highest expense ratio among the three at 0.68%, and it's going to have usually about 500 holdings. It is based off of SPY or the S&P 500. And so far, the average yield has fallen between 10 and 12% on this monthly paying monster. So, how did it shake out? Well, since the inception date on August 29th of 2022, I ran the numbers, and if we had invested $10,000 to start in DIVO, JEPI, or SPYI, let's take a look at what we've got here. So with DIVO, we would have gotten 287 shares. It would have paid. Now, I didn't do dividends reinvested. This is just assuming you kept the dividends. But you would have gotten $1,049.17. The stock value would be $11,637. So you'd have $1,637 worth of price appreciation. It's about a 16% price appreciation over 2 years, for a total return of $26.87. With JEPI, the 178 shares that you could have acquired on August 29th of 2022, you would have received $1,722 worth of dividends. You'd have a stock value of $10,445, so about 4.5% worth of price appreciation. And the total return here is $2,167. And then finally with SPYI, you'd have gotten 206 shares. You'd have received $2,412 worth of dividends, more than either of DIVO or JEPI. And your stock value would be at $10,471. So a similar return as JEPI, but it actually outdid it just a little bit by about $26. And if you combine the dividends paid with the overall price appreciation, the total return on this one actually beats out both DIVO and JEPI over this 2-year time frame. So that's definitely an eye-opener for me, because listen, usually when you have the higher something yields, the less chance you're going to have that the actual share price is going to go up. And a lot of the times, really high yield stuff, the share price over time goes down. That's something that I was a bit concerned about with SPYI. But if something is yielding 10, 11, 12%, the way SPYI does, you don't necessarily need very much share price appreciation. You just need the share price to be stable and not decrease in value. And if it can do that and yield above 10%, then this certainly doesn't look like a bad option to me when it comes to our current income seekers. So where do I fall on this exactly? Well, it's only 2 years worth of history. So that does still make me a little bit uneasy to jump all in on this one right this moment. If anyone out there was adding SPYI because they needed the current income, and again, not only do they need the current income, but they're in their 50s right now, I still don't think that either of these three are great investments if you are in your younger years. DIVO, because of the price appreciation that it has, as well as the decent starting yield, I could see somebody at around age 40, 42, 43, maybe starting to add into that to start building up monthly yield and getting price appreciation. JEPI and SPYI, I wouldn't touch until I'd gotten to the point where I was at least about 50 years old and trying to make that final push toward retirement. So that's kind of where I'm at right now. I am right on the cusp of adding SPYI to the group of dividend-paying ETFs that I think that the Tier 4 investor could and should be taking a good long look at. It's not all about yield. But again, if something can yield this high and maintain its share price and really, it's even maintained its share price better than JEPI has to this point in time. It's grown slightly more, about 0.25% more over the last 2 years than JEPI, while yielding a couple percentage points higher. So I think that there's more history with JEPI. There's a lower expense ratio. Ton of people are invested into it with that $35 billion in assets under management. And it's kind of been the model of a lot of these, as far as I can tell, with the history of covered call ETFs. So don't be surprised if come next Friday, I've added SPYI to that list for the 54 and up investors to take a look at. But if you're in your 20s and you're watching this video and you're out there chasing yield, I think you should stop it. I really do, and add things that have a very aggressive growth rate, even if the starting yield is quite a bit lower, because that growth rate over time is going to generate you way more money than starting out with high yield stuff, even if you're reinvesting your dividends. It just the math just works. So that's where I'm at with that. It definitely doesn't change my opinion on the age of the investor that should be looking at it. But for all of you out there that need the current income, you could do a lot worse than SPYI, let me tell you, because there's a lot of trash out there. You all know how much I dislike YieldMax and wouldn't touch it with a 10-foot pole. SPYI looks pretty good. Looks pretty good. So that's going to be the video for today. SPYI owners and enthusiasts, rejoice. You got this crab on your side with that one. I just had to go in there and run those 2-year numbers myself just to see how things looked out. And hey, the stinking thing outperformed JEPI, and I think JEPI's pretty solid. So that's all it took for me. So hey everybody, links in the video description below to a video on each of the 4 tiers where I break down the stocks that are contained in each of those tiers and why they made the final cut, as well as a link to the ETF themed video where I break down ETFs to purchase based on your age and on those tiers. And finally, you can email me any questions that you may have about dividend growth stock investing or anything investing related to dgicrab@yahoo.com. I have several different videos that I need to start working on that are questions from the audience, and that is material that I absolutely love to make. So keep questions coming in, everyone. I will always respond to you with an email. But if it's something that requires maybe a little bit more than just a couple sentences worth of a response, then I will keep you anonymous, but it might give me great subject matter for a video where I can really go in depth on an answer. So please send me any questions that you have to that email, and I will see you next time, everybody. Let's go get that passive dividend income.